You don't want to buy NVIDIA. You don't want to buy Apple.
Bloomberg
what are you going to
Audio
do?
Studios.
Lori Calvasina joins now with
Podcasts,
RBC
radio,
Capital
news.
Markets. Do you ascribe to the idea, Lori, that the market's lifting even away from the ginormous
This is the
tech
Bloomberg
companies?
Surveillance Podcast. I'm Tom
Sure.
Keene,
So,
along with
look,
Paul
I
Sweeney.
think that we,
Join us
no,
each
I wasn't
day
totally
for
convinced
insight
the 5%
from the best in
pullback we
economics,
did
finance,
was enough,
investment,
but we'll
and
see.
international
I do
relations.
think,
You
though,
can
that
also
we've got
watch
some
the show
strong
live
economic
on
tailwinds in
YouTube.
place. And I
Visit
do
the
think
Bloomberg
that
Podcast
sort of
channel
supports the
on
idea
YouTube
of
to
rotation
see
away
the
from
show
Max 7, the
weekday
large cap
mornings from
growth
7
trade.
to 10 a.m.
So we've
Eastern
actually,
from our
I think
global
similar to what one of your
headquarters
earlier
in
guests
New
said,
York
we've been
City.
telling people to look at
Subscribe
things
to the
like
podcast
materials,
on Apple,
energy,
Spotify,
financials,
or
and also
anywhere else
utilities,
you
which have
listen.
had a nice
And
move
always
recently.
on Bloomberg Radio,
Lori, we're
the
pretty much
Bloomberg
through
Terminal,
the earnings here. We're going
and
to
the
get some
Bloomberg
retailers this week,
Business
of
app.
course, including Walmart and some others. What's your takeaway from earnings here? Did corporate America kind of earn their way into the multiple, do you think?
So look, I think that reporting season was fine. It wasn't anything to get too excited about either way. I think if you go through and you look at the beats on both earnings and revenues, we saw very strong rates of earnings beats. They were less strong on sales. And we've seen that for a while now. But what that's telling me is that corporate America is finding a way to get it done. And we should applaud them for that. But we should also recognize that they are finding a way to get it done. They're really navigating through a tough cost environment. So I think the numbers are good. We've seen the consensus estimate for S&P this year go up to 245 again. That's basically where we were last summer. Usually that bottom-up consensus is in the right neighborhood by the time we get through this reporting season and into June. So I think that we've managed to go through it without too much damage. And there were a lot of bears who were saying the numbers were crazily too high, needed to come down, that was going to destroy the market. Well, that didn't happen.
Hey, Lori, I know you and your team, you really go through the earnings transcripts to kind of get a sense of what corporate management teams are focused on these days. What did you take away from the most recent round of earnings?
It was an interesting exercise. It always is. We've been doing this for a few years now. I would say, one of my main thoughts as we've got these big inflation prints coming out this week is that while companies, certainly weren't saying that the cost environment was good, it was a pretty balanced discussion. So we had some companies saying, well, costs are elevated. Others were saying, well, input costs have come down, or things are normalizing, or things are moderating, or we're maybe calling out something like freight expense that had gotten a little bit easier. That really contrasts with what we heard in the last reporting season in January through March, when it was almost very uniformly a kind of hot inflation commentary, if you will, where it was just nothing but negative, negative, negative. So that makes me feel a little bit better heading into these prints. I'm still a little bit nervous, that the economists, haven't figured out what they got wrong in the first quarter. But admittedly, the company commentary has been a little bit better on that point.
So, all right. So given the fact that we've got yields pulling back just a little bit here, from a sector perspective, Lori, where do you think the best opportunities are right here?
Well, I think that when you're in one of these environments, right, where the macro cross currents, right, and the narratives, it feels like they're just whiplashing, right? It feels like they change every few weeks. I think you want to really stay focused on things like valuation, things like earnings revision momentum, and where you're starting to see, more frankly, upside revisions to analyst estimates than other sectors. And a couple of sectors that really jump out to me are both energy and financials. We've got very strong valuation stories in both. The earnings revisions are improving in both. And while materials isn't quite as strong on the earnings revision front, we still really like the valuations there. And I think when you're getting whiplashed by all these narratives, you really just want to stay focused on the data.
While Paul's been going on here with you, it's been really, really interesting. I'm looking at the materials sector, and I'm as guilty as anyone, Lori Calvasina, of having tech on the brain. Lynn to Danbury, Connecticut. Dow Chemical and others, Sherwin-Williams. I mean, materials, how quaint, Paul.
I know.
It's from my youth when Lori was like in third grade.
It went back when she was on the lawn at UVA. Lori, talk to us about valuation here. I mean, the stock market, the S&P 500, let's just look at the S&P 500. It's had a big move off of those October levels. Has the valuation gotten in front of it? Do I need to strip out some of the handful of the big tech names and then get more comfortable with valuations in these markets? How do you think about that?
So we think about it in a couple different ways. There's forward PEs and trailing PEs. So let's look at forward PEs for just a moment, which is what most people's preferred gauge is. Not mine, actually, but what most people like to look at. And if you do that for the broader market, to be honest, I haven't looked at it for the S&P in a little while, so I don't know exactly what that number is, but we watch every week the top 10 names in the S&P versus the rest of the market. And what you see on the top 10 names is we're right back up to 27 times again. It got as low as 25 times recently. If you just look at a median PE of that bucket, It's way above average. It's bumping up against recent highs. You can get really scared in a hurry if you look at that stat. If you look at the rest of the market, we're trading around 16 times. So it's a little above average, nowhere near past peaks. And it looks to me, when you see those charts side by side, like there's a catch-up trade that needs to happen. You see this off recoveries. One thing typically runs harder off the bottom, then at some point it digests and pauses and the other thing catches up. And I think that's where we are for the rest of the market. And by the way, if you ask your typical buy-sider where they think the market should be trading at, they'll tell you 15, 16 times on forward earnings. And that's exactly where the broad market is, if you strip out those top 10 names.
Lori, thank you. Lori Calvasina with us, head of U.S. equity strategy here, RBC Capital Markets, trying to get us away from NVIDIA on the brain. Not that any of us would be guilty of that. I was waxing philosophical with a beverage of my choice in my hand.
That happens.
About the legs of a bull market and the support and resistance dynamics are different in each leg of a bull market. And idiots, I didn't say that. Idiots that draw little lines pretending to be John Maggie, amateur, it's a good way to get in trouble. Here is the word now on support and resistance. Chris Verrone joins with Strategas. Is the support to this great bull market different than it was 2 Octobers ago?
Well, I think the support to this bull market is what has generally been very supportive leadership. I mean, look at the move we've seen, these global industrials. Industrials working. Industrials have the highest correlation to the market itself. So when industrials are working, the market's generally in pretty good hands. We still have that going for us here. And I think underappreciated, particularly the last 6-8 weeks as the markets come out of this oversold condition, are the financials. Bank stocks are breaking out not just domestically, but look at the European banks. The Japanese banks have resumed the uptrend as well. So if you think about industrials and banks as important tenets of a bull market, I think this one is alive and well.
My metric is the Sweeney Dow 40,000. Then what does resistance look like? What is the character of resistance as we buttress up SPX, Dow, in NASDAQ 100?
Yeah, so 52.65 I think is the high from late March on S&P. What's important for us, we wrote about it this morning, you still have 80% of the S&P above the 200-day moving average, so 8 out of 10 names are still trending. That's not where your big problems tend to emerge from. Your big problems tend to come about when the internal conditions are deteriorating, even as the market grinds higher. That is not the case here. If there's maybe one thing recently that's been on our radar that I think deserves perhaps a little bit of pause, consumer discretionary has started to soften here a little bit, and it's juxtaposed against the narrative of the consumer being very strong. So we're always kind of aware or alert to the price action, not necessarily agreeing with the consensus story. I think that's the one blemish, but otherwise it's a pretty good bull market.
Hey, Chris, I think most of our listeners, most of our viewers on YouTube, they've only known a market that's been led by tech. Can tech still lead this market higher the next leg up, or are you looking for other areas that you mentioned, financials and others?
I think at best here, tech is neutral in terms of its leadership bona fides at the moment. And that I think has been a little underappreciated the last 6 weeks as we kind of corrected and have started to come out of the correction. Tech really hasn't returned as the pronounced leadership of this move. Where else is it coming from? It's coming from materials, which globally look fantastic. We see the move in copper, the chemical stocks. So I don't think tech not leading to the same extent is ominous. I just think it's a reflection of some leadership rotation that's underway. I don't think that's something to fear, but people have a lot of tech on, and I might be a little bit more careful there and discretionary relative to some of the other leadership that's happening.
What do yield charts describe right now?
So I feel against the grain here, and I never like going to bed at night feeling I'm fighting against the tape. I don't mind fighting against the consensus. I don't like fighting the tape. I like bond yield lower here. I don't think I'm fighting the tape, but I do think I'm fighting the consensus. And I like yields lower because look at some of these global 10-year yields. UK 10s, German 10s, Swiss 10s, Italian 10s. They all point lower, not higher. So I'm having our team think about what would be the news flow over the next 6 months if we woke up and 10-year yields were 3.
Well, is it Wednesday at 8:30? Not to pitch the show, but tune in Wednesday at 8:30? CPI?
It doesn't seem like the bar is very high for yields to surprise on the upside here. That's our suspicion, particularly when we look at the global yields. When I go back 3 years ago, we were lucky to get the yield up call correct. And I think about why did we get it right? We got it right because all these global yields were telling us bonds everywhere were going to weaken and yields would rise. I think it's a bit of the opposite setup right here. And then you kind of compare that with, utilities outperforming a little bit better from consumer staples, the financials as we talked about. That doesn't sound like leadership where you would expect bond yields running away.
Yeah.
Hey, Chris, when we had that big move in the S&P 500 off of that October level here, 25% move, a lot of folks were saying, hey, we need to see a little bit of a pullback here. That would be healthy for a longer-term uptrend. Was that 4 or 5% pullback we had in April? Was that it, do you think?
I think it was it for now.
A lot of it. Okay.
48.50 was kind of the big breakout level from back earlier in the year. We retraced back to 49.50. I think we got close enough. All of our, what I would describe internal oversold conditions started to flash. We're at a minimum when you're in an uptrend. Don't get too cute about what level you're a buyer at because the trend is up. And I still think those are the rules.
That's where we are right now.
Absolutely.
Okay, we're going to go technical now. We can do this with Chris Verrone. Earl Blumenthal was one of my heroes. I never met him. He was a generation before me. But what he said was you could get catharsis as a constructive reaffirmation of a trend. And he had a double high pole top and a double high pole bottom. And the answer is a la NVIDIA. You're there, and then it's OMG, down you go, and then you come back. And that's a bottom. Are we seeing catharsis internally within the popular stocks of the day that will allow them to drive harder? Or are we in a zombie lethargy, as Lisa Mateo says we are?
I think we're in a little bit of a rotation away from the stocks that have driven this move for the first 14, 15 months off October 2022's low into something else. And I think you see that reflected in materials working and industrials working and financials working. I think this is less about tech and discretionary, which were kind of the early cycle moves. Now, are these things done? Is Google done? Is NVIDIA done? I don't think so. I just don't think they're returning as the same leadership coming out of this correction that they once were. And I think ultimately to make the case that those stocks should be sold or that they're finished, you need to see bigger volatility. Systems break when vol gets too heavy or too big, and you don't have that yet with those names. We spent a lot of time in the last couple months going back and evaluating how all the big tech stocks of 99, how they peaked in 2000, and the one thing they all had in common was they ended on big volatility. It was 6 months where it was 3% up, 4% down, 5% up. We don't have that here yet.
But Paul, we don't have the dearth of cash flow that we had in 1999.
No, we've got real cash flow.
I look at the cash flow statements of these companies. None of the textbooks I studied have that.
No,
it's an original thing that we're dealing with right now.
I actually wonder, Tom, if that ultimately is going to be the psychological hurdle for people. If these stocks actually begin to weaken at some point down the line, they're going to fall too back on, at least they have cash flow. At least they still earn.
I agree. Yeah.
And that's not dissimilar. The Nifty 50, as they peaked in 73, 74, they had earnings, they had revenue, they had cash flow. Just what the market was willing to pay for them changed. And that, I think, is ultimately the bigger question down the line.
Okay, what's your single best idea right now? All the charts you look at, Jason Trennan's sitting there with an Olivia in hand, and he says, what's the single best idea, Chris?
I think these breakouts in the global material charts are hands down the best thing in our work. I think it's a reflection of an improving China. We were early there.
So you're long copper.
I'm long copper. I'm long Chinese equities. Put my foot on the pedal there.
Very good. Chris Verrone, outstanding. Strategas. So I can't say enough about this, folks. There's two kinds of technical analysis, trend-based and stochastic. And Chris Verrone and I have sampled the Kool-Aid at the trend-based line. That's the technical analysis. Driving the ship in truly the new Citigroup. Jason Rekate joins us right now. Global head of corporate banking for all of Citigroup, and this after a tour duty, including being in Tokyo as early as January as well. You have the heritage and pedigree of your company. John Reed would say, this is a guy we built. What's the new Citigroup look like in corporate banking?
Love the question. I think the short answer is it's not changed from that perspective. We have retained the most important element of our DNA in this gigantic reorganization, which is our globality, our reach, our ability to serve multinational companies across the world.
And Jason, I know you did your tour in Japan. I did my Salomon Brothers tour there back in the very early 90s. Then it fell off the map. We haven't talked about Japan for like 25 years. Why are we now talking about Japan?
Japan is back. It's fantastic right now.
Why is it back? How is it back?
Well, I think Japan's been doing the hard yards for many years. In this long period of deflation, of sort of a stagnant economy, which didn't feel great, the Japanese companies, the banks, the multinationals were continuing to press forward with investment, with reshaping the economy, knowing they had some demographic issues they're going to have to sort out. The outbound investment from Japan became more and more fundamental to their sort of overall strategy as a country. I think what's happened is the world has caught up and figured it out. I mean, there's some important developments there. I think one thing that really helped, honestly, was in terms of just bringing attention to Japan and the market there was Warren Buffett's investment in the 5 trading companies.
Yep.
It just made people say, what exactly are those companies and why are they interesting? We've known about them for years. We've been banks to them for 50 years.
I know. Citi, you guys have been, but it's just amazing. All right, head of corporate banking at Citi.
Yep.
That is it, man. Are you guys making loans? Are your customers, do they need capital? Are you guys making loans?
What our customers need is everything. I mean, lending is an important part of it, and that's what we use to sort of cement and create the foundation of those relationships. But what we do as a firm goes way beyond that. And what we do in corporate banking is try to make sure we deliver the entire firm, a big global enterprise, to them. So they need risk management tools, they need cash management, they need advisory, they need access to capital markets, and that's what we want to make sure that we deliver wherever they need it, whatever currency they need, whatever sort of risk exposure they've got.
I've got to talk to you about the new Citigroup, which I just think is so important, because those of us weaned on John Reed and Walter Wriston and the rest, I'm sorry, it's a bank that's lost its way. A woman from Scotland and the United Kingdom has come in and raised hell in Jane Fraser. The new Citigroup, what is its global distinction when it knocks on the door of the many different kinds of corporate clients you have?
It's not a hard discussion to have with clients because they know us already. They know what we do. I think what our clients were looking for is to make sure, this is the discussion I've had with lots of them, how are you different, how are you the same? And the question is, the things we've done have been very internally focused at making sure we're simpler, we're easier to operate, and that we've removed some areas of bureaucracy that we're not
adding. So are you the boutique of the major banks? Is that what this is really coming down to?
Not at all. Not at all. In fact, some of the things we do for our clients are things that no other bank can do. We operate in more countries. We have the biggest cash management network. We're participating in every corner of the capital market. So not just the easy stuff, not just the G3 currencies, but all of the exotics, all the emerging markets.
So then explain your Saudi Arabian relationship that was fractious for years. Explain the new Citigroup into Saudi Arabia, or the new Citigroup into Mexico, where retail walked away years ago. Explain the strategic corporate banking effort in some of these countries.
It's incredibly important to look at both Saudi and the rest of the region there, because the capital formation coming out of Saudi, the UAE, Qatar, Kuwait, what's happening there is critical, because what we see on these countries and the companies that exist in them is an ability to export capital and technology and know-how. We're seeing some of the most important investments in things like renewable energy coming from that region. So from our perspective, helping those companies and those countries move outside of their home markets is really important.
Paul, jump in here, but the next time you're in Dubai, you need a long conversation with Jumana Bertecci's over there holding court. He needs to get in front of Jumana.
Love to do it.
Plugged in there. Jason, I'd love to get your thoughts on, and Citi's thoughts on India, because a lot of folks are pitching that to us as everything you knew about China for the last 20, 25 years, put it to India for the next 20 to 25 years, maybe even with obviously a more friendly government. How do you guys think about it? You've been there since ever.
I try not to be overly bullish. I'm a guy who lends money, and so I have to be balanced in how I think about it. But I was there about a month ago. I go to India once or twice a year, and I've been doing that for over 10 years. I've never seen a more constructive investment environment than I've seen in this past year in India. What's happening there is extraordinary. There's going to be a massive super cycle, I think, coming out of after this election wraps up. It doesn't seem like it's going to be very dramatic in terms of the outcome. We all kind of know Prime Minister Modi will continue what he's planning to do in terms of investment in this country to make it competitive and get to his 2047 goal of becoming a developed country is incredible. The 500 gigawatts of new power, a rail system, a road system, airports that can't be beat. And you're feeling it already. My last trip there, new tunnels, new roads, shovel-ready projects that are starting to kick off. It's really interesting.
Walt Wriston 101, call on the utilities of America. They're having a renaissance now because they got to build out for AI.
Yeah.
What do you see there, from a granular standpoint? What does your team see of investment in electricity in America?
That's the critical thing. AI, also the support for renewable fuels and synthetic fuels, all of that, plus the EV kind of revolution, the amount of power that we're all going to need, not just the U.S. but globally, is extraordinary. I think we have to take an all of the above approach to this. What's going to happen is we're going to continue to push all of the renewable options. But given what we think is happening in AI and the requirement for data centers, it's going to go way beyond that. We need to make sure. My view is it's going to require nuclear. It's going to require, and there's going to be a significant period of transition where we're going to continue to use things like gas-fired power to get to those levels, because what we're seeing in the U.S. very specifically, but also everywhere else. India, Brazil, China. I mean, everybody's going to be building out massive data centers. The
French led on this. John Micklethwait with Macron. Very quickly here, you're saying we're going to see a nuclear energy build-out across America like what France owns?
I don't think it'll be quite as... I don't think nuclear will be as big a part of the solution for the U.S., but there's going to be more than we've had before. But France has gone sort of all in. That's going to be their long-term solution.
Jason Rekate, thank you so much. With Citigroup, head of all of their corporate
banking.
Are you based in New York?
Based in New York, yeah.
Worst elevators in global Wall Street.
Yeah, can you do an infrastructure investment on the elevators? Jason, thank you.
You got it. Thank you.
So much. Greatly appreciate that. Your daily look at the front pages around the world. It's highlight of my weekend, Mother's Day. I couldn't top it head to toe in Knicks merch.
I did. I got the Brunson jersey. I had the Knicks hat. Yeah, I got hooked up for Mother's Day. Of course, I really wanted to throw it off when I was watching the game yesterday, but that's okay.
You said, well, I'm trying to get tickets with Paul to the next game because he's got those tickets he's got. What do you got today?
Okay, this one came from Lucas Shaw's newsletter. Always go to that.
Awesome.
Yes, really good. He's talking about how Netflix, Amazon, and Apple, they want to change the way they pay Hollywood talent. So what he's saying is that Apple has begun basing pay on how the series or movies perform. So for example, talent will receive bonuses based on three things: the number of people who signed up for Apple TV Plus to watch, how much time they spent viewing, and the cost of the program relative to the size of its audience. So this is something different. He's saying Netflix, Amazon, they're also considering performance-based compensation, but it's something different as to how they
I read every word thinking of Paul Sweeney, Lisa, and Paul, to me, and the back end of Lucas Shaw's brilliant note is, okay, show us the data.
Yeah.
And they think they have a rule book different than the days where we knew Gunsmoke was number one on TV.
Exactly right. You're exactly right, Tom. So, I suspect the talent, and more importantly, their agents will be like, okay, that's fine, but show us
the data.
The data. We don't mind getting the back end. And as opposed to
Shogun does well and something else doesn't do as well.
Yep. So,
but you got to show the data.
But again, Amazon, Apple, Netflix, they're the ones that have the money. They have the checkbooks these days. So they can drive the show.
Yes. Okay. So along similar lines, we've been talking a lot TV advertising, how it's been going down, but a lot of brands moving away from TV advertising. They're moving to Google, Meta, TikTok to reach these new audiences. Here's an example. Mondelez, they wanted to promote this limited edition Oreo cookie. Nice. So they didn't spend a dime on TV advertising. Whoa. Where they went to Instagram, they went to TikTok, they went to the websites of large retailers like Amazon and Walmart. So you're seeing this shift because the people they're trying to reach, the Gen Zers, multicultural audiences, they aren't watching enough TV.
And so this is May, Tom. Yeah. May is a time for the upfronts, which we've been done since the beginning of time for television, where the TV networks sell maybe 80% of their next year's advertising inventory today in May for a discount. Does that even matter anymore? Are brands even spending on broadcast and cable television? And here's the data from the Wall Street Journal story. The maker of Ritz Crackers and Sour Patch Kids candy is spending about 15% of its U.S. ad budget on TV this year, down from 42% 3 years ago.
And what's important here, Digiday had this. I read it cover to cover now, learning about YouTube and what we're doing on Bloomberg surveillance. And Lisa, they have great, legitimate math that on Instagram, most people look at the still photos. They don't look at the reels. And the math's like 6 to 1. It's huge. Where people, the reels, okay, cute, great, nobody cares. They look at still photos for messaging.
It's interesting because it used to be the opposite.
Yeah.
So that's interesting, that little shift there.
I don't know. Next.
Okay. We've been talking about inflation data, right? PPI, CPI, but apparently chicken sales. That's what people are looking for the new inflation gauge, okay? Because shoppers trade down to chicken from pricier meat cuts when food prices are high. So that's what they're seeing, that shift. So diners are buying more chicken wings at fast food places, frozen tenders at grocery stores. You had Tyson Food, they're bringing in higher profits from poultry instead of their other meats. Restaurants pushing chicken options. So you start to see that. Cheaper chicken prices, though, not likely to stay for long, of course, because wholesale prices, they're rising. The demand's ticking up. Supplies are starting to thin out. But looking to chicken.
A dwindling supply of cattle in the U.S. means meat packers like Tyson are paying more to secure their livestock. Where are all the cows going? What's the big deal? What's the big thing?
Goldman Sachs
Just make
did
more
a
cows.
beautiful exercise on this. I'm going to say 15, 20 years ago. And, you know, it links beef rather, with pork and with chicken. And the dynamics are very sophisticated. About,
I like chicken.
Should we raise more cows or not? And then somewhere in the rest of the country, it's like, what do we do with the pigs, and then what do we do with the
good pork
chickens?
bellies? Can't eat a good pork belly.
We're eating way more chicken at home.
I eat more chicken. I know,
You know,
because it's cheaper.
Not just, you can't eat beef all
No,
the
you
time.
can't eat
So
all the
chicken
time.
you can eat more frequently,
Well,
right? You're the
Yes.
health expert. You
Yes,
tell me.
and turkey, ground turkey. Yes.
Okay. Very good. I'm
Really,
not eating.
ground
I'm not
turkey?
eating.
Ground
them.
turkey.
I won't go that far.
Come on, you gotta switch to the ground turkey.
Next,
Telling you.
because I don't want to hear about ground turkey.
Okay, my favorite story
This
of the
is
day.
not good.
Costco becoming the hotspot for adult birthday parties. Okay, so it's blowing up on TikTok.
Tenfolio.
Here's how it works. Okay,
missed
Fruit
this.
10.
I hope my husband is listening to this. But the unsuspecting birthday person, all right, they start seeing them random friends, relatives throughout the stores they're shopping. And they're like, oh, it's a coincidence. How nice. Everyone's here today. And then all of a sudden, when they're done checking out, they go to the food court at the end. And there everybody is. Surprise, surprise. They sing happy birthday. It becomes this whole party. But one person said it's because it's a cheaper alternative. Okay, she spent just $30.88 on her birthday dinner for 7 people because they bought hot dogs and soda combos. Okay, that's what it's coming up to. They wore Costco hoodies, got into all the, you know, the birthday celebrations. So it's cheaper. I mean, unless you go on a Costco shopping spree like me and you spend $500, and it's not really cheaper. But
So this
is the
party
new
was
trend.
hosted at the Fort Oglethorpe Costco warehouse in Ringgold, Georgia. Pretty cool.
Yeah.
So I mean,
telling
I'm
you,
not. So is it the hot dog? Is that the thing?
It's
to eat
the
there?
hot dog soda combo. It's like
Okay.
$2 or something.
People
like,
love
it's
the
crazy.
Costco hot dogs.
I know.
Right? And
My
that's a
mother
thing.
goes to Costco for 2 things: the hot dog and vodka, and that's about it.
I'm with her on the vodka.
Say that again.
Mom.
My mom
just
loves
woke up.
Costco
Happy Mother's
for
Day, Mom.
the hot dog and the vodka. That's what she goes
That's
there
all
for.
you need. What else?
That's it.
I can live on that.
But
So,
you
all right,
have
so
to
we're
have a
at Costco.
membership to attend the party. That's the other thing. How they kind of try and
Oh,
reel
I'm not a
people.
member. I don't
Yeah,
think.
so you're not a member. You can't go to the
I might
party.
Be a member. Okay,
No,
so you have to get a
you have to
member.
be a
How do I
member.
get a member? I just go Costco.com.
Yes.
Okay. All right.
Okay, Lisa Mateo, thank you so much. Ending on Costco. Can we get,
We're
you know, can we,
extremely large at Costco.
should we know that we're going to Costco this coming weekend?
Sure.
See a Lisa Mateo sighting?
Yep.
Get the
We'll
foo
there.
over there.
Where's our Costco, Lisa? Where do we go?
Costco, I go to the one. There's one in North Plainfield. There's one
Wow.
in Union.
All right,
There's
all
one
right.
in New Jersey. I know.
There's not one in the
There's a
Upper
big one
East
in
Side
Brooklyn,
for Tom,
actually.
right? There's not one.
No.
For the Upper Side for Tom. Okay.
You can go to Brooklyn. It's
Lisa
easy.
Mateo, thank you so much. Greatly appreciate this.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.